What type of ETFs? We can slowly lean into that.
Yeah, my ETFs are effectively mimicking the index, right? That's the S&P 500.
So, I mean, there's Chinese indexes, there's other indexes, right?
Yes.
And there are fund houses that create an index to create ETF. You know they do that, right? They do that all the time.
It took me a while to understand what you just said, but yes, they do.
In order to create an index funds, the fund will go and create an index and then create a fund to mimic that index.
Yeah.
Right?
Track the index.
Track. Use the right words.
Yes. Okay. Yeah. Okay, before we roll today, as with every other episode that Anthony is on, there's always he's the Tai Senior of the team, right? As with every episode that Anthony is on, we are going to do a giveaway. That's a new standard, huh? Yeah. Okay, so today, once again, our giveaway is sponsored by Audio Technica, right? So shout out to Audio Technica, which you see all our new sets, right? It's all from them, great. And of course, our friends at City Music. But today's giveaway is the ATR2100X USB mic, which is actually what you all use at home, right?
Yeah.
Like all our remote recordings are done with this. So if you're an aspiring podcaster, don't. But if somehow you don't have a proper mic, I think it is time to get a proper mic because like these days there's recording everywhere. I always find it very amusing when I need to record with someone remote and then they tell me, Apple mic, that one cannot. It's like, cannot. It's not good enough, okay? If you would like to win the Audio Technica ATR2100 USB, very simple, okay? Listen to today's episode and share on your socials and then write something that will inspire us, right? What is your best ETF tip? Because today that is the topic, okay? If we like your sharing, we like your stuff, and then we will choose you as a winner. And for more details, check out the Financial Coconut Instagram page, okay? Okay, so today we are back in studio with the gang, right? Clearly all guys, right? Investment must be all guys, right?
Bring Sarah back off.
No, Sarah was recording. No, we're not doing a sub now. We're not trying to prove our alternative point, okay? We're not diversity for diversity, right? We're trying to bring good voices. But it's really very hard. Do you think investing is a guy topic?
I mean, what else do guys talk about? Besides
soccer,
money, sports.
Well, what's your definition of a guy topic?
What guys talk about generally?
Okay.
Yeah, investing is... do you have any ladies friends that you like hardcore talk to about investing?
Nope, I just keep telling Sarah. She's just forced to listen to me.
She's so done. That's why she's not in this episode today, right? She's done. She was recording the other one. She's like, okay, I'm going to take a break. Aaron, you're on your own, right? So yeah, but that aside, right? Like investing is something that I think a lot of people aim to do, especially on our platform, on our channel. So today we want to continue this investment series. I think the previous one was quite good. Right, like how to pick your own stocks, everything, all that jazz, right? So we did the 2 episodes.
To it despite my own voice. So.
Serious? Oh my god! Yeah. I know, it's very scary to listen to your own voice, right?
I was like, I said that. Oh, okay.
Yeah, quite smart, Right. Give us a pat.
Why did I say that?
I was like, maybe I shouldn't have said that.
So yeah, then with the whole like stock picking, part 1, part 2, I think we're going to spend a little bit of bandwidth to talk a little bit about ETFs, right? Because I don't think everybody wants to pick stocks. And I do think the ideology is different. Like the methodology about picking stocks and ETFs are quite different. Maybe we can start with that, right? Is there any difference in ideology when you think of like, do you want to pick stocks or do you want to use ETFs?
Okay, I guess I go first, right? So,
because you're the Tai Senior, right?
No, I think because I'm just sitting closest to you and you look at me.
Okay, great. I love how the eyes settle it all. Yes.
Even though I don't see you, I can sense your presence.
Yes, so I can feel it.
But anyway,
thank you.
I think look, at the end of the day, it's what you want. And I think that's why this episode is useful because people think ETFs, people think, diversified, people think safe and all that. But that is not necessarily the case. And if we talk about active stock picking, then you can actually actively choose ETFs. You can choose sector ETFs, you can choose geographic ETFs, whether you want to buy S&P 500 only as an ETF. That's also a choice. So I think hidden in a lot of these things are actually choices that people make when they are investing. And that is something that hopefully we can bring more awareness.
Yeah, and for clarity's sake, you are also one of those people that has a champo, right? You have like some stocks.
I have everything.
Too much money, don't know where to deploy. Check out
Spray and pray
Yeah,
mechanism.
spray. check out the earlier episode. You will know he said something. I got too much money, too much cash, need to deploy. Okay, no, but so for clarity's sake, you are not averse. You're not like one side to like only pick stocks or only do ETFs.
Yeah, no.
You just kind of pick based on what you
for
think.
my personal tolerance, I do have quite a lot of ETFs. I'm not 100% ETFs, but I do have quite a lot of ETFs. But I think, and this goes back to our earlier conversations, whether it's about what you want and what you can tahan, right? Or what you need. And then you choose the asset and you choose the allocation that fits what you need. But yeah, I have ETFs, I have lots of them. And actually, if a beginner came up to me and said, what should I buy? First thing I go, ETF. Easy. And then what we mean by ETFs, then you listen on.
Okay, then you listen on. So what do you mean by ETFs? What are ETFs?
So what are ETFs? ETF is, just think of it as like a basket of stocks that you can purchase once. So if you like strawberries, you like coconut, you like a whole bunch of fruits, instead of buying one strawberry, one coconut, or one banana, you can just buy like a whole basket of them. So that's just like how it works. And the best part is that you can also buy and sell it like any other stock. I think that really just sums it up in the most layman way.
Okay, fair. So do both of you have ETFs in your portfolio?
Yes.
Oh yeah.
Okay. What type of ETFs? We can slowly lean into that.
Wow. Okay.
Yeah. What type of ETFs? You don't need to divulge anything if you're not comfortable.
Yeah,
but it's
no.
like-
So,
yeah.
my ETFs are effectively mimicking the index, right? That's the S&P 500.
So, I mean, there's Chinese indexes, there's other indexes, right?
Yes.
There are fund houses that create index to create ETF. You know they do that, right? They do that all the time.
It took me a while to understand what you just said, but yes, they do.
In order
yes,
to
yes,
create
yes,
the index
yes.
funds, the fund will go and create an index and then create a fund to mimic that index.
Yeah.
Right?
Sorry,
So
track the index.
Track. Use the right words.
Yes. Okay. Yeah. But let's be clear, that is very common, right? People do that. All these fund houses do that all the time.
Absolutely.
Okay.
In fact, a question that maybe for our listeners, we will also probably want to find out what's the difference between an index and an ETF, because that's a common question that I get actually.
Serious?
Yeah, because like people will be like, okay, but I have this ETF, but is that the index? I want to buy the index. Why am I buying an ETF? Like I get some questions that way, right? And you can understand why it's a little bit confusing. So maybe Reggie, you want to tell us?
Okay, simple question I think, right? Simple question. Simple question I think. Chim I give them, right? So very simple. Usually the confusion comes when you're talking about like index ETFs, right? Essentially, it's an ETF which is a fund, okay, that is used to track an index. Okay, so this comes when the conflation comes in, because you can never buy an index. An index is just a measurement. Right, it's like a barometer of something. Let's say the S&P 500 index is essentially the summation of the quote unquote best 500 companies by the S&P guys, right? Standards and Poor's, which is what do you call them? Rating agency. Yeah, rating agency. They rate that these 500 companies are the best. And then they put them together in an index, and it is just a rating. It is just an index. It is just like a measurement, right? You can't buy this measurement, right? But there are many other funds in order to sell you, the performance of these measurements or this index, they will create a fund that you can buy. And just so happens, some of these funds are traded on the exchange. That's why it's called ETF, exchange traded funds. So you cannot buy index, but there are certain ETFs that are index funds. They are tracking the index. Okay? Am I making it clear?
Yeah.
Thank you. Yeah, that's why you pay me for that. Okay? Yeah, stop asking me for a discount. Okay? Sorry, recently a lot of sales stock. So yeah, sorry. Yeah. Okay, so based on that, right? What are the other ETFs? Okay, since on that note, we essentially established that index funds or index ETFs are only one type of ETFs, right? So what are the other types of ETFs out there?
One of it is like sector ETFs, and that's something that I play with a little as well. It's like during your
A little or a lot? I feel like you play a lot. I feel like Aaron is like dabbling in this like thematics for like every other. Yeah.
But I think one of the easiest themes to follow is actually energy, because of the recent, especially ongoing for a while, a lot of problems going on in the world. So that allows us to actually play with a lot of energy stocks quite well, because we know that energy is something that everybody needs. So we just pay attention to the market, and you can actually dive straight into energy stocks. Example would be XLE. So that's just an ETF that you can get into to look into the energy sector. I think like right now, oil prices are also starting to hike up. We know it's winter season. So, some of the energy stocks would probably be outperforming in the near future. Maybe not financial advice.
Never. Financial, never. It's not strong enough. Never. Okay, this is purely for entertainment purposes only. Thank you.
Educational also.
Education, entertainment purposes only.
entertainment.
Thank you.
Yes.
Expanding our horizons.
Never. Okay, yes, please.
Yeah, so I sometimes just flip between that as well. And another sector that I like to look at is finance sector and healthcare sector. So that's your XLF and XLV for healthcare, not XLH.
Okay. So XL is a series, right? Which fund house is the XL series? There's usually fund houses, they will create funds with like the first few letters is the same one. It's come from them, right? I cannot remember and it's okay, I'm not going to say it anyway, not sponsored. So how Anthony agree energy play now? Of course, that is my full-time job. Asking interesting question, be entertaining and stirring the pot.
Okay. So I mean, on the flip side, right? I think a lot of the attraction of a sectoral ETF is you get exposure to the entire sector. So you buy XLE, you get exposure to energy. You buy 10, you guess what it's exposure to? TAN.
TAN. I don't know.
Solar.
So
of course you get sunlight, you get 10. It is hilarious. I love that name, right? But I
sense
think
of humor.
Hey, don't like that. I know it's quite funny.
What is okay? I don't want to continue that. There was a period of time there was an ETF called Wheat.
Really?
Yeah, which is essentially tracking marijuana. Right. Wheat, WED, yes.
Yeah, but going back to sectoral ETFs, I think the problem I kind of see with sectoral ETFs is that one, you can't really pick outperformers. So even within energy, for example, are you upstream, midstream, downstream? Are you a super major? Are you, PTT, which is now listed in Singapore and you can buy? And they all have different business models. They all have different margin profiles. So it's when you buy that sectoral ETF, you are partially saying that, well, somebody else has said these are the best 30, 50 in this sector, therefore I'm buying them. You are outsourcing your judgment. And essentially, if you think that you have different judgment and you take the good with the bad, right? So within that, upstream, midstream, downstream, they all have very different margin profiles. So, do you really want to be...
very different business model. It's not even just margin profiles. They're all different.
So
fundamentally.
Do you really just... I mean, I want upstream because exploration high risk, or I want midstream because, it's kind of commoditized and it's stable cash flow. They are very different companies, right? So, by buying all of this, you are, yes, diversifying and decreasing your risk, but you are also kind of foregoing, the risk that you want to take.
Yeah. And I feel like energy can be a season. Like can be a discussion for a whole season, right? Just this midstream, upstream, downstream thing. I think a lot of listeners will be like, what the hell's going on? What stream? Right? I only know streaming, right?
But I think at the same time, it's showing how complex an ETF can even get.
Yes.
Right.
Yes,
and I think that's the point we want to drive home, is the fact that people will say, right, don't ever invest before where you go and buy ETF. But actually, what ETF is a big question.
It's getting very conflated now because every fund house has an ETF now. Right, so they go around all these like events and they tell you, our ETF. So everybody's borrowing the ETF.
Fully diversified,
Everything is fully diversified. They're fully diversified within the sector. Right, so
do
how
you see
diversified
the
are you?
Southeast Asian Growth ETF?
What is that?
Hey, remember your newsletter?
We
wrote.
Caught in the act right here.
Subscribe to our newsletter.
Reggie needs to put up a YouTube video of sharing screen so that he subscribes to his newsletter.
Okay, I will subscribe to our newsletter and get a ping, okay?
Yeah, but I think that is kind of... So I mean, the only reason why we wrote about it in a newsletter was that it says Southeast Asian high growth ETF, right? So I think, great. I'm investing in growth companies, I'm investing in all that, but they are investing in Indian companies that are really doing like manufacturing and really... and that's sort of like Indian, Vietnamese companies investing in manufacturing. There you go. Hey, but the name doesn't really match. It's quite different. I expected a very different company profile from between I saw the name to I saw the top 10 holdings, right? So I think if anybody wants to do diligence on an ETF, especially sectorial ETFs, you need to be quite clear. Yes, there's a name that suggests what they want to do. And then there is that other bit of what do they actually hold and what is their positioning so that you can better understand that you are buying what you think you're buying.
Yeah. And a lot of these names are marketing, right? So they will use all these things to make it sound very sexy, and the composite within, I would expect Shopee to be their biggest holdings, or at least one of the bigger holdings.
I don't think so.
You
Right?
know,
It was
yeah,
just,
like-
I was telling VinFast to be one of their biggest holdings.
Okay, yeah. But never mind. Never sponsor. Not my problem. Okay. But then, so on that front, okay, essentially we established a few things. Right? First, we established that ETFs is not just index funds, right? Index funds form a big part and an important part of ETFs, but there are many other ETFs out there like thematics, right? And in the realm of thematics alone, there are all these other patterns. Right, there are the HO thematics, healthcare, energy,
AI.
AI, yeah. I don't know what get rotated inside, but there are all these HO thematics that are always there, and then there are like new era thematics that half the time I feel like they're just trying to scoop your money, right? So then you look at it, it's like, what is this, right? And the quirkier the thematics, the more expensive it is. Usually, we can share what is considered a cheap. Like an affordable ETF from a management fee standpoint, and what is considered expensive.
Yeah, I don't actually know how much.
Yeah. So from an index fund, index fund's perspective, is 0.03%, right? Yeah. So just to say, okay, for clarity's sake, index funds, I know a lot of time when you use whatever app, whatever thing, they will tell you they charge 0.5%. In actuality, if you are just broadly diversified with them, if you buy the funds directly on your own, the management fee is only 0.03%, right? So that is more than 10% and more than 10 times markup. Okay. Yeah, it's a lot. It's crazy. And you think it's very small, you go and compound, you see for yourself the numbers, right? So that is that. Okay. And on average, thematics will go somewhere from 0.6 to 0.9. Okay, on about there, right? So, and I'm not saying that is the benchmark to go, okay? I'm just saying that is what everyone is charging, right? Which is why a lot of the more obscure funds, you'll be surprised, even some of the not so obscure instruments, like the REITs, they also have their ETFs, right? 0.6%.
Yeah, it's actually quite expensive.
It's very expensive.
The REIT funds are quite expensive.
Yeah, it's very expensive. Yeah, I was doing a comparison. I was like, why are you so expensive? This is such a simple tool. It's like, okay, sorry. Yeah.
But Anthony got special rate, right? With the amount of REITs that he has.
I wish.
Pulling your leg, bro.
Yeah. Okay, fair. So based on that, right, I think we have lined out a few things, but I want to go further into discussing like what are the different strategies playing with ETFs, right? Because I think you kind of touch a little bit. So for you, even as someone that buys ETFs, is also broadly diversified long-term holdings.
Yeah.
Right. So that is your strat, right? For you actually trade on some of these themes.
Yeah.
Right. Like what is the reason of choice for these things?
I guess for me, because if you look at, I guess, a bit more of macro and fundamentals, then sometimes you can just have a sensing that certain sectors will generally outperform. And if you follow the very typical business cycle chart as well, then you kind of know how to rotate into certain sectors. And something that I use is a sector rotation graph. So it just gives me a rough gauge on where we are in the cycle. Usually I'm looking at like a weekly cycle. So I will buy into a particular ETF, or usually I'm just buying into a sector for like a 3 months hold. And if I'm not directly buying into the ETF, I will just be buying options. So I'll be selling a put option usually, so I can get in at a better price. Because for sectors, if I am right, I don't really need to make that too much of a gain. So just selling a put option usually puts me in a very favorable position. And if I do get called, then I'll have to purchase the shares at a lower price, which isn't too bad because for most sectors, I can actually hold it for a much longer term, especially for something as cyclical as energy stocks. It does collapse, but it also does rise back up really, really fast. I think the only other one that I would really want to hold for a long term would be like finance, because that generally has a much consistent uptrend. So mainly finance, energy. So those two.
Clarity on the put options, right? Do ETFs also have put options?
Yes. So if you're buying like XLF, XLE, they do have put options. They do have options. I think all the way to weekly options. So that's pretty good.
Yeah. Okay. And not all funds have that, right? Essentially, someone must issue.
Yeah, not all
Yes,
counters
yes,
have that.
yes.
counters. Not all counters have that. So it depends on who issues.
Yes.
Don't take that as why you got no option on this thing, right? You must go and see for yourself. Not all counters have that. Okay.
Yeah.
And for you, the strat.
Yeah, so I think mine is kind of the mix. So I'm also active, but I think I'm active more on
You're not
the,
so active.
Yeah,
I'm active, but not so active
I'm
lah.
active more on the fundamentals
Yeah,
side
yeah.
of things. So it's not so much playing cyclicals. It's more on the sense that, well, I think there are companies that will become the next generation of leaders. I want to get into them now. I want to get into Amazon 10 years ago, not now, right? So that's precise, and I think we talked about it in the active investing episode. So that's precisely it. You have a basket of ETFs, which are really index fund ETFs, because that is your base, right? That is you. The only risk you are taking there is market risk. You're not taking on any other, other weird risks, whether it's volatility, whether it's business risk. You just go, I want the market risk, and that's it. And that's a chunk of my portfolio. Then with the other, smaller percentage of your portfolio, you can take riskier plays. You can buy HubSpot, you can buy HubSpot as a Salesforce. You buy the disruptor, you buy the
think
challenger.
HubSpot is gonna win Salesforce?
I'm not going to say anything about it. hey, Salesforce is an AI ETF, okay?
Huh?
Yeah, it's in the Goldman
Because
Sachs AI
Einstein.
ETF.
So got Einstein on.
Because it's big enough to be in the ETF. You know what I mean, right? The market cap is big enough
Yeah.
for
So-
the fund. If the fund comes in with like $100 billion, right?
Yes.
You can buy a lot of those things.
Yeah.
So it needs to go somewhere. Money needs to go
It needs to
somewhere.
go into big companies,
yeah, and then
right?
in the open position. And if any fund owns more than 5% of any company, they have to report in their 10K. Right. So then most funds don't really like to tell you what they own. Or at least they will tell you as a marketing strat. They don't really like to tell their competitors. So apparently that is a consideration. I heard, I cannot buy more because once more than 5%, I have to report, right? So yeah, something to think about. Yeah, continue.
Yeah, but then I think if that's the way I want to position my portfolio, then that means that for my ETFs, I cannot buy as a sectoral ETF, right? I cannot buy a very narrow ETF because what I want for that part of my portfolio is market risk. And to what I want market risk, I buy a market index lah. I buy a market fund lah. So I think that's the general thinking behind it.
Thematic is just an add-on.
Yeah,
it's just
thematic
a
is an
double
add-on.
down.
Like, I
because I
think-
believe this team is stronger. So
Yes.
my main vein is an index fund, and
Yes.
then I will double down on I think healthcare is going on the up.
Yeah, like I bought
double down.
I bought financials when I bought quite a lot of financials when
Late last year.
when I was bank run, right, early this year. I was like, financials never die, but I don't know which bank will die. And I think this is maybe a use of a sectoral ETF. I don't know exactly which bank will die, but I know financials as a whole will never die. So my choice is I buy JPM, Citi, the big banks, or I buy a sectoral ETF and I take the good with the bad. Maybe one or two regional banks to call it, but that's fine. As long as the finance
You can digest.
sector as a whole recovers, then my ETF will do well. Yeah, so maybe that's a use of a sectoral ETF for special plays.
And on that note, I think we also need to establish that it's not always about the newest, trendiest strategy. Those are age-old strategies, right? And as long as you're comfortable, you know what's working, you understand the thing, it's okay. You can go with it, right? Like the other day, I was talking to someone else, right? Some investment guy, right? I mean, we always talk to investment guys, so I don't even want to talk about it. But I was talking to him, and then his strategy was like, okay, I kind of know, he's like, don't make big bets all the time, but when you make big bets, be very clear about it. So one thing he's very sure is the shopping malls will never die, okay? Or that's what he believes, right? Shopping malls will never die. So when the REIT had a downturn, he mortgaged his property.
Wow,
right?
he mortgaged his property to
mortgaged
buy
his
REITs.
property.
Wow.
Mortgaged his property, went in and buy REITs, right? Then when the REITs prices went back up, he sold the REITs, positioned into some of the government securities because there's a cyclicality to those things, waiting for the market to come back, exit. Now he's back in the property market, right? So you know that kind of people is around, right?
Wow.
Right. So it's and these are not trendiest things, like what's the latest new strat, there's this new product, this new vertical. These are age-old strategies, right? If you know what you're doing, if you understand, the thing that you own, then it works lah. It works for you.
And you need to be comfortable. You need to have conviction, because what's fundamental underpinning that is that the market will turn.
Yes,
right?
yes.
That's why you have the confidence to buy, because the market will turn.
People will still shop.
Yes.
That's the idea, right? You listen to the
I
earlier
have an
episode.
actual building.
Yeah, actual building. People will still shop. Singapore will not sink, right? So these are some basic assumptions, right? It better be in the risk factors of anybody that's issuing something on those grounds. Hey, welcome to the Financial Coconut Podcast Network. I'm your host Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC. Okay, fair. So I like we have a whole spread. Different people are using ETFs in a different way, right? So that's cool. How about we venture into the more like interesting ETFs? Your leverage, your inverse, right? All these
TQQQ.
Yeah, you all know what I mean, right? You all know what I mean, right? They are not
I only
all
go QRD. I go to that for sure.
They are not all ETFs, right? I mean, they're all ETFs, but they are really different, right? So maybe we can start, right? Anybody wants to start?
Actually, apart from just like the leverage ETF, something that has been gaining popularity recently are covered call ETFs. But I think it's quite hard for like Singaporeans to really make use of it because we are taxed 30% on it, on the dividends. The whole idea of covered call ETFs is you get really, really high dividends while they are still trying to track the S&P 500. Usually they fall short when prices are moving up very quickly. But during downturns, they can give you, I think recently it's like at a point 12% per annum. So that's really, really good, especially when it's tracking the S&P 500 relatively well. So, but the problem about being Singaporean is that you get taxed 30% on that. So that brings it down to like 8% dividend, which is still pretty good. But
do you need the risk palette for 8%?
But is this the 8% on top of the market return?
This is just the dividends.
Oh, okay.
You just tax 30% on the dividends. So capital gains or capital loss, it's not touched at all.
Okay, so essentially what they're doing is they are giving you the option premium that they're harvesting as kind of like dividends, or they're paying it out as dividends. But you are still tracking the market, so you are kind of getting the market risk as you go along with that. Then the downside is, well, if the market suddenly shoots up, if tomorrow the Fed says, haha, interest rate cycle high, done, I'm over, right? I'm going to start cutting. And then market shoots up, you get called.
You get called.
And you
difference
are
is
out
the
of
difference out of the money.
market.
Yeah.
So I think that's kind of the thing that, I mean, I've not dived too deep into covered call ETFs, but that was kind of the lingering question in the back of my mind, right? So what happens if you get called out of the market? Do you wheel and then they sell puts for you to go back into the market, or?
I guess it differs with different types of ETFs. So actually for covered call ETFs right now, there's I think like two camps. I think one of it is like XYLD, where they usually get called because they are selling like at the money. But if I'm not wrong, JEPI is JP Morgan's version. If I'm not wrong, I cannot remember exactly, so don't quote me on this, but they do have they sell it a little bit out of the money. So that actually gives lower returns, but usually it doesn't get called.
What is the difference?
If I'm not wrong, it's close to 5%. I cannot really remember on that, but it should be about 5%. Yeah. But I know that one of it, if I'm not wrong, it's XYLD that sells at the money. Don't quote me on that. We can easily search it. But XYLD was the one that was returning like 12% because during the market downturns, they were just like collecting premium non-stop. And when you're selling at the money, 12% per annum is
but that's
pretty good.
Kind of the downside to that, right? Because you are essentially, one is sure, if you sell at the money, your premiums are higher, but you are foregoing, you are really increasing the chance of getting called and foregoing the chance of being out of the market when it swings up, which is really the time you want to be in the market.
Yeah. So
right?
that's like...
So I think that is... So you are kind of getting like a quasi fixed income instrument because they are always selling out of the money. Yeah.
Okay, for clarity's sake, in the money, out of the money, right? Very simple, okay? Yeah, very simple. Here's why I'm here. Very simple, okay? So if today the index or whatever market that this option is playing on is at $500, okay? Trading at $500, in the money is $500. Right, that means essentially what options do is I feel like someone must sponsor me to explain this thing, right? Essentially, what options does, right, is there's two main components. One is the time value, the other is the difference to the price that it strikes, right? So the strike price is let's say when they say they are in the money, that means if the market is trading at $500 today, the strike price that this option is underpinning is based on $500 today also. Right, so based on that, essentially it has very little room to maneuver. It better move laterally or go down. If not, it will strike. And if it strike, then because you sell the calls, you have to buy the index, right? And this whole thing is run by the fund. right? So the fund will run this whole thing, and in general, I think it gets quite complicated from here lah. Right, but yeah, so out of the money essentially means it is okay, not very far out, because very far out the premiums will be very lame, right? So usually slightly out of the money would be like maybe a 5% differential, right? And that will factor into essentially the 5% difference from between the two option funds provider, right? Usually that is how it's factored. Okay, fair. Fair,
Fair.
Approve,
Approve.
Okay. So that is the difference. It's get a bit cheap lah. You sponsor me, I will write down a proper script to explain. Okay,
We can talk more about
we can
options.
talk more about options another time. Okay, but cool, that is interesting. So options is one thing. What about things like inverse, things like leverage?
Okay, I'm not going to answer your question.
Okay.
I'm going to say another type of ETF.
Okay.
It's less popular now.
just completely ignoring you right here. Like, hey, what about this?
Like there is
Okay.
no host here.
No, okay, so
Right,
so
yeah.
two things, right? I think one is like ARK, ARKK, not in fashion anymore, right? But that's also an ETF, right? So ETFs can also be actively managed. It's not just they can trade in, trade out every day. It's not just they buy 500 companies and they just always hold that 500 companies in that proportion forever. So I think that's a kind of misconception about ETFs.
Yeah. And ARK actually manages it very complexly. Right, the way they go about managing their active.
Well, I mean, if
active
you want to
trades.
look at randomness as complexity, then yes.
enough. Right, just
Clearly, he doesn't have any shares in that.
yeah. I don't have also. So
I mean, I kind of treat ARK as like high beta tech, right? So if you think that high beta tech is going down, you short ARK instead of shorting individual companies. So and then therefore you are shorting the market instead of shorting the market in that sector rather than shorting individual companies.
Curious, have you ever shorted ARK before?
Yes, and QLD. So these are actually my main hedging instruments. Where I think like, okay, maybe, well, not now, but a month or two back, the market is slightly overbought, right? Then, okay, fine. I think there's going to be a bit of a downturn. I will short QLD, right? It's easy. You get cash. IBKR pays you for that cash. You get a bit of interest on that cash. So it's okay lah, like it protects you from downturns when it hits.
Okay, fair. So that's the actively managed part. Now I can move on with my question, right?
I thought it was QLD.
So yes, I move on with my question, right? Anyone wants to take like inverse, leverage? I think those two are also very big things in the market.
For inverse is like, I remember the famous one was inverse Tesla, wasn't it?
Yeah.
I
think
Wait, there's an inverse Tesla
Yeah,
ETF?
so we talked about the market. We had inverse Tesla and covered call Tesla.
Yes.
And we were trying to
And
figure
the whole
out.
ETF is built on Tesla
Yes.
alone. Then why do I need an ETF? Or whether someone is managing it, is it?
Yeah, somebody
Okay.
manages your options for you. Somebody rolls it for you.
Okay.
things like that.
So
Yeah.
essentially, they charge a management fee on that.
Yeah,
Okay,
and effectively an inverse
Oh my goodness. Okay.
ETF. Well, in this case, the inverse Tesla was mimicking exactly what Tesla was doing, but the opposite.
So it's shorting Tesla all the time, right?
Yes.
Mhm.
And I think one reason why inverse ETFs have come up is because in some, especially in US retirement accounts, you cannot short a company. So you buy a short counter to mimic the exposure of shorting a company.
See, when there's a market, someone will come in and
So
fill
there's
that
a way,
shit.
there's
When there's a
way.
market when you can charge fees for it, somebody will fill it.
Yeah, of course. No, and that's how a lot of new hype ETFs are created. I call them hype ETFs. Like essentially, there's a hype. The stock prices have all moved. It can be a whole sector. Usually, it's a whole sector.
What was Kathy Wood's ETF? What's her name? Oh, it was. Yes, yeah, okay, that's right.
Yeah. So I think it's a classic hype ETF lah. And the hype of it all, then some of these big funds or big trusts, right? They'll come and say, "Hey, we really want to get into that, but our mandate don't allow single stocks. So can you do something?" Right? Then you go and package a fund, then you sell to me, right? That's usually how it's done. Yeah, but but my biggest qualm with that is always usually they tend to enter when the market is really at its high point. Right, because there must be some sort of a hype, then these funds are created, then sold to you, right? By the time it comes in, the fund itself has already entered the position at a high point, right? And then now you're taking over at a high point on the management fee some more,
Yes.
right? So like, so far in my short investment journey of like 8 years, I've not seen a great hype ETF, right? Usually after the hype settled down, then you can go in and see got interesting things to pick now. Right. Or at least I'm the I'm the cheapo investor, right? Go and find that thing.
Vulture.
Yeah, the voucher.
Yes.
Voucher is the word. Yes, I'm the voucher. Yeah. Okay, fair. So that is essentially inverse, right? It's not that complicated. Or are there more complicated inverse ETFs? I'm sure there are, lah. But any touch point on those things?
Not really. I think nowadays you can create an ETF for everything.
For everything,
I think
anything.
there are ETFs that track or they are meant to mimic exposure to like hedge fund positioning. This
I know they got ETF mimicking Nancy Pelosi one.
yeah.
Oh, yeah.
Oh, and then like the short gym and long gym to follow Jim Cramer recommendations. So there's
Just short gym.
just SJF.
Yeah. Whatever Jim say, sure their side. You go and see for yourself. Jim
But
Cramer.
long gym has outperformed
So,
short gym.
Has long gym outperform index?
No.
Market cycle. Okay,
No.
so
In the last 6 months that they have been
in the
established.
last 6 months. Okay, anyway, don't care about gym. Okay, yeah. Okay, fair. You wanted to say something?
Oh no, because I saw a video recently on TikTok. Some guy was like comparing all of what Jim said. If you were to short it, like how will you perform? So if you take like the super long term, right, from when he first started, actually shorting Jim like outperformed everything else.
Short gym, right? Okay, it's still the position, right? Okay, fair. So what about leverage? Right? I think leverage is also an interesting one. I get all these. Sometimes I get these. My listeners will come in, right, and then they'll say, okay, how about I long position, right? So I long the market, right? But because I want to have a bigger long position, so I will use a leverage inverse. Right, and then I was like, wow, you're getting very cheap these days, right? So just
No,
trying
because
to,
it's everywhere.
yeah, it's everywhere, it's right. So in order to have a bigger long position so that I don't lose out, because essentially the short position is to hedge the fluctuations, right? So from there, then they think like, okay, how about we leverage on that short, right? Then we have more for the long, right? So maybe what is your take? How do you look at this?
Yeah, I mean, I short leverage ETFs because my growth part of my portfolio is high beta. So instead of shorting, 1.5 times my notional on QQQ, I short QLD. So I short 0.7 times and it just all mathematically kind of works out. I think we need to get back to basics, right? So what a leverage ETF is, it's not like so imagine what it is essentially $1. I have $1 of cash, I buy $2 of stock, right? How they create the exposure is through derivatives. And that's why the usual reasoning is leverage ETFs don't hold too long. Because as your derivatives kind of roll, and you need to roll for your derivatives to retain that, 2x that exposure, that there's a burn and there's some sort of tracking error. So
Yes.
don't hold too long, right?
Yeah.
You won't perfectly track forever. So I think technically that means that, okay lah, if you buy leverage ETFs, your idea is you don't want to hold for too long. Although if you bought the TQQQ for the last 10 years, you would be laughing all the way to the bank and you'll say I'm stupid, right? So I mean, in the bigger scheme of things, the tracking error is small compared to what the market has earned outside.
For QQQ, yes.
Yeah.
Somehow you 3x QQQ, right?
Yeah, you QQQ, it'll be great.
Yeah.
I don't really play too much with leverage ETFs. Most of the time, I would be
I
trading
already
options.
play derivatives, right? Yeah, okay.
My options are leveraged enough. I don't need to
Options are very leveraged already. Yeah.
I think it's like what Anthony said, because for leverage ETFs, like there's the decay, and it's not favorable to me. When I'm doing options, then time decay is actually on my side.
Of course, because you take the time premium, right? That is the game, right? Yeah.
Theta gang.
Yeah. So yeah, those guys. Okay. Then on that front, right, I want to ask, so what about those extremely short options? These days they are everywhere.
Like daily options. Actually right now I'm doing a series on my side, which is actually selling 0 day to expiration options. I'm selling a vertical spread like every single day when I have time to trade. So like I'll monitor the position, and I'm trading on the SPX. So it's a very simple trade. It's I'm selling a 50 wide spread. The risk to reward ratio is like 1:2, so it's like day trading, but it's just like one position every single day. Yeah, and it's actually pretty interesting.
How is it doing so far?
So like right now we're on week 6. I'm breaking it up. So the first month ended up with, okay, so a bit of context, yeah. So I'm risking, the max loss is $5,000, but I've never ever reached max loss before, because once I hit negative $200, I would exit the trade. Otherwise, when the trade expires, usually I'm up about $100 to $120. So it's about a 1 to 2 risk to reward ratio. But because I'm always getting about 16 to 12 delta out, I'm like 70% win rate right now. So the first month I ended up with a profit of $600, about there. Oh, it's actually on YouTube. You can watch that. Self-promote.
Promote. You share so much. Please promote. Follow the TikTok channel. Go on your YouTube.
But so I was doing that. So now I'm in the middle of the second month. Right now I'm only up $90 because there's some losses as well. So I had like a good week. So I made 500, I have 2 losses, and then now I'm down to just 90 in profit. So,
but you've done quite a few of these kind of trading cycles, right? Like trading series.
This is
never perform very well one.
This is.
I come across all the things, right? It's like, why Aaron keep losing money? But is it true?
That's what drives you.
That's what drives you.
It's a journey, right? So no, he's losing. Then at the end of it, then like makes it.
I'm so close to just throwing this shit over. Fair.
So I'm in the middle of doing that now. So it's actually zero day to expiration options. But not that I encourage anyone to really be doing that, because if you if you make a mistake,
right? It's for content.
Actually, part of it is for content as well.
It's for content. Right. So essentially, his running capital for content is $600. Right? 5,000 at risk. Right. Okay.
Yes.
But I guess that also is like, it's important to be careful if you're doing anything like 0 day to expiration options and derivatives as a whole, because like at the end of the day, the max loss is $5,000. If I go to sleep and I don't close my position, then I have $5,000 at risk, which can actually be realized on the day itself.
Yeah. Many things can happen. So okay, fair. In closing is there any other thing you want to add for ETFs?
No, actually I have a friend that, so I don't play leverage ETFs, but my friend does. And he does it for 2 hours every day.
Okay.
And that's all he does.
So as in he does it as in
he sell, he buy, he sell. Literally like that for 2 hours every day.
Okay.
He has a cap.
So he don't just trade, he trade a leverage ETF.
He plays on the leverage ETF.
Yeah. So because it increases the volatility, right?
Yes.
Essentially, doubles up,
and with
down.
that, he has a cap of how much he needs to make every day. So once he makes that, even if it's less than 2 hours, he'll close shop and go sleep.
So we should get him on the show
Yeah,
right? What's your
Tell us what you
is
do.
it working?
Share screen.
Yeah, share screen. How is it? Right?
We start at 9:30 live recording.
If you want that, put in the comment section. We'll try to get someone to come in and do those things, and have a good time.
A very good thing that people can listen to as well is, compare ETF to like unit trust in Singapore. What do you guys think about it?
Yeah, I mean, I think fundamentally it's just the difference in where the instrument is traded and sold, right? So I think increasingly you have been getting a lot of mutual funds which have lowered their costs by quite a bit.
Recent,
very recent innovation. So yeah, due to ETFs, competition and all of that. So a lot of the historical mutual fund confirm expensive. I think you need to look a bit deeper.
Slowly change already.
Yeah, it's slowly changing.
And I would say it's not even that slow. It's been already been happening for quite a few years, right?
Yeah. And then so what differs to me is really the sales channel, right? ETF, I go IBKR, buy sell, whatever. It's all my choice. I can't really just go and buy a mutual fund by logging into. Okay, I think somewhere you can now. Somewhere you can.
Some of the funds some of the funds have their own homepage.
Yes,
you can go there and transact directly.
But I think primarily a lot of them are still sold through intermediaries, whether that's your banks or your robos or all of that, right? So where you get exposure to it, I think, and their sales channel for those things are a bit different, but fundamentally you have so many mutual funds that will track S&P.
Same thing.
So many mutual funds that's like MSCI, all world index, right?
I think there's a mutual fund right now that has like a 0% expense ratio for the S&P 500. I think
Fidelity,
Fidelity, zero.
So they're
something,
using it as a hook to hook in the customer,
something.
right? Yeah. Okay. That's the strat lah. They bring you in cheap, right? And after that, then they flood you with other things.
Or they might be earning somewhere else, right? Like it's just not necessarily a matter.
Okay.
Can't remember the exact name, but Fidelity 0 S&P 500. You'll probably find it.
Guys, yeah. Okay, interesting. What's your take then? Between unit trust and ETFs?
I guess for me, it was always like mutual funds, the fees were always very, very expensive. But for me, I always prefer ETF because you have more control. And it's like the evolution of like investment, right? It started off like having only active management like mutual funds. It became after that people had like index funds, but it was still like a mutual fund, like mutual index funds. Then eventually became ETF. So to me, it just feels like ETF is like the latest and greatest thing for
Okay.
investing so far.
So trendy boy going for the trendy product. Right. But it's fair as some of these things close, in terms of the fees, then he puts into question like what is that, right? But
I think some rebranding needs to be done as well with unit trusts, right? And clearly,
unit trust branding very bad lah. Even my auntie can say, 不可以买 unit trust one lah. Sure lose money one lah. Right. So even you can hear it from
no,
the
but
auntie.
you can hear
right?
it from your parents'
It's
generation, all of this.
colloquial, right?
Yeah,
That's why nobody wants to use the word, but a lot of them are still selling the same units, right? So it's just they just stop using the word, right? It's smelly. But yeah, okay, cool. In closing, if someone is trying to start investing with ETFs, what is your advice for them? Or maybe not advice. What will you do? cannot use advice. Cannot use advice. Yeah. What will you do if today you just start? Yeah.
I think it's good to try it out, but I think firstly they need to be aware of the risks, right? What we've talked about ranged in massive, like the risk is from little bit to quite a bit, right? For example, with indexes, market risk, right down to covered call ETFs, right? So I think you need to be fully aware of what you're doing. And if like anything, right? If you're not fully aware, you don't know the risks, don't go into it yet. Learn about it and then slowly go into it.
Yeah, like, share, subscribe. And yeah, I will subscribe. I have one. It's just I too long never log into my personal email. I've been spending so much time as a company email. You're doing all those stuff. But yes, if you share this episode and then tell us what's the biggest learning point, then you got a chance to win a mic. Yeah? And if you're very good, then you send me your audio recording, I'll recruit you. Yeah, what about you? Any other things you want to add?
I guess if it's ETF, well, I guess if I was completely new,
if
not
you
for other
are
people.
completely new, yes.
Completely new, not too sure.
But you have all the information that you have today, but you're completely new.
What's the capital?
And if I didn't have much time to do a lot of research, not too much time to always be rotating between sectors, then I'll be looking into the S&P 500.
Fair.
Yeah, I mean, I think it's rough. And I think I kind of echo, right? What's your starting capital? What do you want to achieve? And we always go back to this question, what do you want to achieve?
What you want?
But, sometimes the best time to start is yesterday. The second best time is now, right? If you want to grow and compound your wealth over the long term, you can't undo what you did 2 years ago.
What has happened? Yeah,
right?
you can do it.
And so even if you go, okay, you know what? I don't know anything. I don't really want to read about it. But I can stand losing a bit of money. Then just go and buy a market ETF. Because at the very least, you're putting yourself in with a chance of growing your money rather than putting it in your bank where you are almost confirmed losing it to inflation.
Yeah, fair. And I think my point is to accentuate the point that I think a lot of people are doing this. They will put their money with a service provider and the service provider will charge them 0.5% to do broadly diversified when they can do it on their own at 0.03, right? So maybe you want to consider, exploring this, doing on your own thing. Okay, we'll see you next episode. Thank you for your time. Love it. Oh yeah, and follow their channel, TikTok. Right, TheWeeblings, so that you can see whether he actually made money. This is important.
When he makes money,
yeah. Or when he makes money, let us know. Okay, put in the comment section. Okay, thank you guys. Thank you for your time. Love it.